Welcome to Money Majlis. I'm Suvo Sarkar and this is the 24th and last episode of Season 1 of Money Majlis. Over the last 9 months, including the 4 extra episodes, I have brought to you 28 episodes of insightful content. Hopefully you've enjoyed all the episodes and I'm grateful for your love and for your support that has made Money Majlis the #1 business podcast produced in the UAE. So thank you, my dear listeners. To celebrate the end of Season 1, I've got a special guest on my show today. An entrepreneur who sold his first successful startup years back and is now growing his second successful startup. On this beautiful January morning in Dubai, I'm happy to host on Money Majlis today the founder and CEO of Beehive, Craig Moore. But first, let me acknowledge the support of my 4 sponsors, MasterCard, Vio Bank, Network International, and Aqua Now. Thank you, sponsors. You make this podcast possible.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by Vio Bank. Fuel your ambitions with banking designed to power your success. Discover more at vio.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aqua Now, the premier crypto-as-a-service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
My guest today on the last episode of Season 1 of Money Majlis is Craig Moore, founder and CEO of Beehive, an EAN enterprise company based in Dubai. Beehive is the first peer-to-peer or P2P lending platform in MENA to be regulated by the DFSA. Prior to Beehive, Craig was the founder and COO of Butterfly Software, a UK-based data analytics company acquired by IBM. He has also held sales, consulting, and finance roles at Dell, EMC, Hitachi, and HSBC. Craig graduated with a BA degree in accounting and finance from Nottingham Trent University. Craig, welcome to Money Majlis and welcome back from your holiday. How are you doing? And tell us a little bit about your holiday.
Thank you, Suvo. Delighted to be here. Yes, just returned from a winter holiday in Nairobi in Kenya.
Yeah.
So that was nice to get away. Weather is very similar to Dubai at this time of year.
A lovely country, Kenya.
Yes, beautiful country. Great people as well. So it was nice to get away and come back now, start of January, refreshed and ready for 2025.
And today is the first day at work for you.
It is the first day
And
at work.
on Money Majlis, wonderful.
Yes, indeed.
Craig, congratulations on completing a decade since you set up Beehive way back in 2014. And today, you are the leading peer-to-peer lending platform in the region with over 15,000 investors funding as much as 3 billion dirhams across 1,500 businesses. Now, only 5% of startups make it to the 10-year mark. So well done. You're one of the 5%. Tell me, my first question to you, Craig, is what made you decide to venture into the world of banking? I know you were at HSBC last, but to the world of fintechs. And what made you choose Dubai? You're based in London. If you look back 10 years, Craig, what are some of the seminal moments in your journey with Beehive?
So I would say the reason I looked at this region originally is, as you mentioned in the intro, my previous business, Butterfly Software, once we sold to IBM, I became interested in the whole kind of space around peer-to-peer, alternative lending, and that was really taking off in the UK, the US, and Europe. But there was nobody doing that within the MENA region. So there was an opportunity to come to region and bring a new business model. to region. In addition to that, there was nobody looking at actually the Islamic side of lending as well within the peer-to-peer space. So the opportunity to create a Sharia compliant solution into this region seemed quite an intriguing proposition. Could we solve it? And could we launch that? So it was really those two areas. One, there was an opportunity to bring a new business model to region and to try to execute that. I had only really been to Dubai in the region. I'd got friends here. I'd come here on holiday socially. So it seemed the right place certainly to base the business and to start off from. And there was an awful lot to navigate. So at least having people who I knew in Dubai that could help me navigate, pull together a team, introduce me to people who could be mentors and help guide the formation of the business and the launch of the business was incredibly important, but also to look at creating, as I said, a Sharia compliant proposition as well that would have wider applications within region.
And Craig, as we know, we share a favorite ex-boss, Rick Putner, who was your ex-chairman and my ex-CEO at Emirates MBD, my first boss actually at Emirates MBD. Very fond memories of Rick. I'm sure you worked with him for a few years.
Yeah, great guy. And I think Rick was instrumental certainly when we were setting up Beehive. Whilst I already had been on an entrepreneurial journey, I hadn't got much, I really hadn't got any experience of business in region. So whilst I knew what to do in order to kind of put the foundations together, get the proposition in place, having somebody who knew the region well, having somebody that had the credibility and quite frankly the gravitas because of his positions. Rick was just leaving as Group CEO of Emirates MBD, very well respected, and I think he was critical to provide credibility to Beehive when we launched. And I think that was instrumental in paving the way to make sure that Beehive was accepted as a proposition that people could look at and say, okay, this is an interesting proposition. If Rick Putner is willing to put his weight behind this as well, therefore there's the credibility aspect. So, and beyond that, he was just a great mentor, certainly in the early years, as I was already not just navigating the business side of the region, but also, you know, living here. So I think, Rick, fantastic guy, and he was a superb chairman for Beehive all the way up until the EAND investment. So definitely somebody that I have an awful lot of respect for.
In fact, Rick was the person who convinced me to join Emirates MBD back again. I had left it for 2 years, and I came back from Abu Dhabi to Dubai thanks to Rick, and a lot of fond memories of working with Rick. Just a big picture question now, Craig. The P2P lending market globally is estimated to be around $200 billion and growing at a fast rate of 25% CAGR. In the region as well, we've seen emergence of platforms both in the UAE as well as Saudi. We've seen government, here, for example, in the UAE launching Dubai Next to provide working capital finance, equity participation, real estate, etc. Including coverage of art and charity as initiative led by the government. We've seen central banks, we've seen financial free zones, and securities authorities have put up clear regulations to guide the growth of this kind of propositions. How do you see the space shaping up both in the UAE and in the GCC region in the coming years?
I think as a proposition, it will continue to morph. And I believe there is a huge opportunity, as we're doing at Beehive, to collaborate with a lot of financial institutions, try to take the best bits of each model or each organization, bring those together in a harmonious way. So what I think a lot of the fintechs do is they try to bring a degree of agility. They try to bring new ways of problem solving. But what you also need when you do that is to make sure that you have the credibility, you have the checks and balances in place, you have a regulatory framework, but also accepting that a lot of the established players, the banks, the other financial institutions, have an awful lot of data, have an awful lot of existing relationships. And it's how can you work alongside those? Sometimes you'll compete, naturally. But other times it's, is there an opportunity to make 1 + 1 = 3? And certainly in our 10 years, we have, I guess, gone through a journey where initially we were seen by everybody as direct competition to the banks, even though we were, quite frankly, a very small player in the region. But over time, as we have worked alongside banks, started to understand what banks and financial institutions are focused on, once you get that greater understanding, then you can start to flex your propositions around something that is actually more cooperative than competitive. Right? Even though you accept that in certain areas you may compete. So I think generally as an industry, you will see a lot of players kind of continue to come into the market. Fintech is a very, very, very broad term. Right? Everybody, you know, it almost splits between fintech and tech fin. Right? So there are a lot of companies providing technology solutions into finance. That's very different than somebody who's trying to operate a finance company using technology. So I think you'll continue to see growth in those areas. I think you'll continue to see banks and financial institutions partnering with fintechs. And you'll get some kind of creative destruction as well. You know, I think ultimately any market can only support so many players. So you will have some winners and you'll have some losers and you'll have some M&A and you'll have mergers and you'll have, you know, businesses that won't last. And that's normal. I just think it's a particularly exciting time in this region as people try to solve more and more of the kind of financial challenges. The key is who will ultimately come out on top over the next 2 or 3 years.
Craig, I've been a banker for 35 plus years. You worked in technology, you worked in banking, now you run a fintech for the last 10 years. More actually. What is your assessment of the state of partnership between banks and fintechs? What can each party do better to make this a more holy alliance, let's say?
Yeah, I think it's probably had a number of false dawns across the industry. And I think one of the major challenges is understanding where both parties come from. And what I mean by that is if you look at a lot of fintechs, I have seen quite a few, and we've been burnt ourselves, where they have started to work with financial institutions and they just aren't truly aware of the amount of work that has to go in the background in the banks, or the amount of approvals that need to be done. And the problem is, it's about speed. A lot of, and this, not just in the finance industry, but this goes for a lot of startups and tech businesses, is a lot of startups cannot afford to wait the length of time it takes for larger organizations to go through their approvals and to be able to wait before revenue starts coming through. And you see this a lot, is that, and it's not actually the large organizations' stated aim, but they can strangle small businesses through the red tape, through the kind of constant approval process. And it's you know, it's kind of, I think it can be quite sad when you see a startup that says, or you know, an early stage business that says, we're going into partnership with this organization. 12 months, 18 months later, they still haven't brought anything to market with that organization. And particularly if they are a fundraising startup, they've got a financial runway.
Correct.
And they are too optimistic about how quickly these partnerships are going to generate revenue. And they end up basically strangling them, running out of money, having to pull out of the partnership because the revenue isn't coming. So I think that's one area. And then I think the second area is, it's the old adage of almost kind of revenue for vanity and profit for sanity, is that I think sometimes fintechs can get too focused on potential revenues, and that weakens their negotiation position when they go into partnerships, and they aren't equally beneficial. So I feel that sometimes when you look at the commercial agreements, they are probably too one-sided. And it means that if the startup, the early stage business or the fintech cannot generate not just revenue, but it can't generate profit from those partnerships, then over time that partnership is very quickly going to die. And I think that's a huge, and I've seen that with a number of businesses.
It has to be a win-win for sure.
Yeah, it has to be win-win. Yeah. Otherwise, all you're really doing is either doing a knowledge transfer, which isn't helping clearly the smaller organization, and then the frustrations creep in, and then that's what breaks down a business relationship. So there needs to be a far more honest conversation up front, is really what needs to happen. And it needs to, there needs to be a realistic commercial agreement that means that both organizations can benefit from the partnership.
Tell me, you as Beehive have got relationships with banks in the UAE, in Saudi, in Oman, elsewhere. What has your experience been personally of dealing with banks?
We've gone through a huge learning curve. And I think the more you deal with banks, the more you understand banks. And then your kind of later conversations with them are far more informed. So in the early days, like most organizations, we probably underestimated the amount of compliance and approvals that needed to happen, and the speed at which that could happen in a bank, and would get frustrated, quite frankly, because as an organization, we tend to work in days and weeks, not months and quarters and almost years. So you have to be realistic about how long a project or a setup or an approval is going to take. And we've been able to bring that to bear in some of our later partnerships, where we know what we have to approach upfront. We need to be able to tick these boxes for this proposal or this potential partnership to move through the cycles within the bank, and to make sure that we've got the right level of support at the right seniority, but also making sure that you are bringing along the organization in the bank that is going to be working alongside you. Right? It's not always about getting top down. You've got to get top down support, but you've also got to get the support of the people that you're going to be working alongside. And you've got to be prepared to be kind of, seeking to understand from them what are the areas of concern, or which areas do you need to give them comfort around, and also to be very open about, listen, this is how we look to work, this is how these are our aspirations, because you need an alignment of aspiration in order for something to work. There's no point you going into a partnership thinking, look, we want to achieve X, Y, Z, and the bank is saying, but we want to achieve ABC, because everybody will spend an awful lot of time working towards a contract. And then actually, you only make money, or the partnership is only successful once you're operating. And yet there's a huge amount of focus on signing a deal, when actually you need to focus on how we're going to operate together, and how are we going to make a success of this project.
Well said. Tell me, open banking regulations have been announced by at least 3 countries, UAE, Saudi, Bahrain, in the region over the last few months. Do you think open banking will make a difference and provide a fillip to P2P lending and to the collaboration between banks and fintechs?
Yes, I do. I think open banking, if you look at Europe, for example, once you have more seamless data transfer between banks and new entrants, then that should only really benefit the consumer or the businesses if they want to access alternative sources of borrowing or other financial kind of services. I think the key is how will it work in practice, right? Because a lot of open banking is also about how you empower the end user and their data and how that's used, and how that can be transferred between various different service providers. So I think it's a big opportunity. It lends itself naturally to collaboration between fintechs and banks, sharing of that information, bringing new propositions to market. I think invariably it will need to be used sensibly as to and what are the approvals and how does that data move and things like data security and all that good stuff. That's going to become incredibly important. But if used properly within the ecosystem, then it should have a net benefit for end users about services they can access and customer experiences that are available to them.
Absolutely. Let's move, Craig, now to the topic of SME lending in general. And we know the SMEs are a very important part of the economy of the region, contributing 90% plus of non-oil revenues, non-oil GDP, 60% plus of employment. And we also know that financing is key to enabling growth of small businesses. However, the SME lending gap in the region is estimated to be a significant US dollar 250 billion. That's a big number. 250 billion US dollars is the gap in lending to SMEs, and 90% of SMEs depend on their own funds or support from friends and family to grow their business. Now, while platforms like yours, Beehive, are helping to address this, the task seems enormous, to be honest, right? I mean, challenges right from the lack of financial records, as well as integrity, plus a one-size-fits-all approach from the banks, restricts the options for businesses. What do you think, Craig, are some of the top actions that the financing industry, banks as well as other lenders, the businesses themselves, and institutional bodies can take to address this? You've been doing this for 10 years, so I'm sure you have some strong views on this.
So I think if we look at those three areas that you just talked about, the first one is the industry, so the financial institutions. You're right, it's a huge gap. And this region isn't particularly much different than other parts of the world. Right? There's a huge SME funding gap globally.
Yep.
And you pointed out some of the challenges. Some of the challenges is that the SMEs don't particularly keep good records. They're not necessarily financially literate when it comes to how to take debt in the right way to help grow their business. When is the right time to take debt versus equity versus friends and family support? So, of course, you can continue to educate the SMEs through better financial literacy, through better bookkeeping, using a lot of the new tools around accountancy. When I look at somewhere like the UAE, the kind of introduction of VAT meant that records need to be kept in a different way, and businesses needed to be a lot more financially savvy in order to meet their obligations. So I think there's generally a lot can be done with the SMEs and education. But if you look at the financial institutions, a lot of it, I think, comes back to banks in particular have struggled as to where does SME, and when I say SME, I really mean the S side of it, the smaller segment and the micro segment, is banks have struggled traditionally where does this fit within our organization? Does it fit under retail because we're essentially lending to a business owner? Does it fit under corporate because we want them to produce the kind of records that we'd expect from a corporate in order to make an application for lending?
Yeah.
So I think that degree of, or that lack of cohesion across the industry, is it fitting under retail banking, is it fitting under corporate banking, means that when an SME is approaching one bank compared to another bank, it will get a different, it will receive a different set of questions, it will receive a different approach, quite frankly, from the bank as it assesses that application. So I think banks being able to be more flexible with the kind of lending products that they're able to offer into the industry, because, you know, a micro type business, if it's effectively moving stock from A to B, buying, you know, it's importing stock and it's selling into the local market, typically that will look for short-term financing solutions. Yeah, that's what they need. They don't necessarily need a 4-year loan in order to, you know, rent office space for 4 years and all that good stuff. They're not trying to grow their business in that way. They're trying to grow their business through volumes.
Yeah.
Therefore, short-term financing. For other businesses that are looking to grow, hire people, bring on people, there will be a lag before those people are economically productive and contributing to the business, then that needs a different type of funding product.
Totally.
You don't want to be funding that through 3-month short-term cash flow lending. So trying to match the right type of solutions. And that's where I think, you know, fintechs working with banks can really help. Right? Because having almost a menu of what is the most suitable lending product for me and my business, I think is critical.
Yeah.
Also, what that does is it means that everybody becomes far more educated about the proposition and the expectation. So, you know, what is expected of the SME, what is expected of the financial institution, and everybody is clear on essentially what the proposition is. Also, I think you need to look at understanding from a regulatory perspective, you know, in the SME space, what can SMEs do from a regulatory perspective to help them access the financial ecosystem far easier? And how much of that can be done almost collectively across the industry. So, well, I'll give an example, I guess KYC, AML, right? So we'll know this, and you know, a source of frustration is if you're applying to a financial institution for a loan, you know, each institution is doing its own KYC, AML. Right. That is incredibly intensive, right? When you're having to provide that kind of documentation. And what I find fascinating, or probably over the last 25, 30 years of industry, is if you go back 30 years ago, the most cutting edge technology was in the corporate world.
Yeah.
Right?
Yeah.
Using a BlackBerry or those kind of tools. They were seen as more cutting edge. It wasn't used in the consumer world. It was used in the corporate world. Corporate IT systems were more sophisticated than you would access at home. That has completely flipped. Now, the consumer has more up-to-date technology access than any corporate, because corporate can't keep ripping and replacing every year.
Correct.
Right? So by default, its technology is already straining.
Yeah.
And we know with legacy systems and legacy migration, it's a struggle.
That's an interesting observation, actually. Yeah.
But what it does is it sets an expectation. So now the consumer's expectation is above that of a corporate.
Yeah.
Yeah. Now the CEO can go home and see his child using a piece of technology that's better than the technology that he's using in his office.
Sure.
And his frustration comes, well, wait a minute, if they can do that and, you know, ABC and something is instantaneously done. Yeah. And yet we try to do it in our organization and, you know, I'm told that it's an absolute nightmare and it's going to take us 6 months in order to implement this feature, just this feature, right? That expectation change, I think, has a massive rippling effect. So regulators and you know, institutions, industry have to come together to say, how do we bring some of that speed, some of that agility, some of that expectation, whilst maintaining security? Yeah, because that is obviously incredibly important. getting that balance, how do we deliver and reduce some of the duplication? Because what we're talking about here is duplication. So I think there's an opportunity to reduce an awful lot of duplication. It goes back to some of your open banking questions.
Yep.
It's how do you rely on, are we able to rely on the KYC AML of a bank? Therefore, we don't have to necessarily do that. At the moment, everybody has to make sure they're doing it themselves. But I think there is a huge opportunity to take out a mass amount of duplication, particularly in the finance industry.
Yeah, fair point. And do you think AI will play a big part in this?
Yeah, I think there's a huge opportunity for AI to do that. Like all things in regulated environments, you've just got to make sure you've got the checks and balances that allow everybody to be comfortable with the results that come out of the AI.
We talked earlier, Craig, about the lack of data from SMEs that makes lending difficult. But we've now seen VAT being introduced across the Gulf in most countries. We've now got credit bureau in most of the countries in the region. Do you think the combination of both those two, VAT records and credit bureau, makes it easier to lend to SMEs?
I think it definitely makes it easier to take comfort from some of the SME data. I also think that as you see improvements in the data that is collected, the timeliness of the collection of that data, particularly in the credit bureaus, it helps not only to look, because whenever you're looking at any form of credit assessment, you're looking at two things. You're looking at the ability to repay, which is predominantly numbers and performance of the business, but you're also looking at the willingness to repay. And things like the credit bureau are incredibly important in that.
Yep.
You're not only looking at the business, but you're looking at the people behind the business. You wouldn't want to be lending, $1 million dirhams to an SME that looks really healthy if suddenly the individual behind that is 10 million in debt.
Correct.
Right. So you have to look holistically as much as possible. So I think, the more that data is collected, the better. But still, it's how you use that data. It's how you incorporate that into credit assessments and assessments of whether you want to make the lend. But I think it can only be a good thing as more and more data sources become available to lending institutions.
Greg, you have a book of just under 500 million dirhams in the UAE, and you managed to return a remarkable 10 to 13% to your investors annually in recent years across your term loans and working capital finance offerings. You also maintained a very healthy loss rate of under 2%. What are some of your underwriting and pricing related capabilities that allow you to do this, which seems, almost unreal to have that kind of return and that lower loss rate, especially in a market that is often very cyclical? What do you do differently?
So we've obviously gone through a huge evolution over 10 years. And our credit models have adapted and evolved. In fact, we're probably on our 10th version of our credit model. And as you expect, that credit model incorporates a lot of learnings and a lot of lessons from the last 10 years. What we found work, what doesn't work, what we can do better, how you weight different criteria in your decision-making process. But one of the things that we've always looked to do, even from day one, is, we want to lend to the top 20% of businesses, right? So we want to be the lender of first resort.
Okay.
Yeah? We're not trying to be the lender of last resort. Right? We're not subprime lending. I think that's important for people to always realize, because again, as I said, fintech is a wide umbrella. And if you look at lending globally, you have different type of lenders. You have people that are trying to lend to subprime, and therefore they're going to charge subprime rates because they understand they're going to take a lot of losses and they need to compensate for that. But that's never where Beehive wanted to play. We've always focused on how do we help quality businesses get access to finance in a timely fashion so that they can continue to grow their business and expand. So with that in mind, we've always tried to focus on a criteria that essentially fits that. So we'll have our kind of opening box. Does the business fit within that? If it does, then we feel that we can help them. If it doesn't, we're very quick to say, look, we're not the right solution for you. It may be that a bank is the right solution for you, or a finance house might be the right solution for you. So I think that's the first thing, is we're pretty clear on what is our box and where we want to stay. Secondly, I think also is to understand that it's about looking at the day-to-day of a business. So, some financial institutions are focused on audited accounts, right? If we get into detail, audited accounts were never really of interest to us, right? Principally because they're already out of date by the day they're published.
Yeah.
What we're bothered about is what's happening day to day, right? How is the business operating? How is cash moving through your accounts? How are your ledgers performing, both your debtors and your creditors, and trying to build up almost a real-time understanding of the business as we're doing that assessment. And for us, that was one of the most important things. And we saw there was a real difference between how we were credit assessing and some financial institutions were credit assessing. They were relying on data that we wouldn't particularly rely on. And we wanted to focus on the ability to make those repayments in a month, in 3 months, in 6 months. So I think we took a slightly different approach. We took almost a cash accounting kind of credit assessment approach. And one of the things we did is incorporated lessons very, very quickly. We're a relatively flat structure. If we started to see some NPLs, we wanted to understand why we were seeing those NPLs. What lessons could we learn from if we had that time again, would we still make that same lending decision? And the ability to have that feedback loop very quickly into a model, I think, was critical for what we did. But also understanding that the economy is not something that you can control. You can control what you can do in the lending.
Yeah.
The economy is the economy. And, as you and I have spoken about before, we've seen some cycles.
Yeah.
Right. We obviously saw 2016 was a huge cycle in the SME space in the UAE.
The great SME crash of 2016.
Yes. And again, a lot of lessons were learned from that.
Yeah.
Certainly, what we saw is that for a lot of businesses, there were a lot of healthy businesses that were brought under, not because they weren't operating well, not because they weren't profitable, but quite frankly, they had a liquidity crisis. They were overexposed on debt, and some of that debt was crystallized by some of the lending partners. So some of the banks suddenly converted short-term revolving credit into term finance, and that crippled the cash flow of the SME. So again, understanding what can happen if if the economy turns or certain things happen, how will the SME adapt to that? But also, how can you help the SME through that? So again, interesting when you talk about the great SME crash. One of the things that we saw is that some of the SMEs we were supporting that had 2 or 3 bank lines, we actually took over all their lines, right? Because if their crisis is one of liquidity, and we could provide the liquidity, then actually the fundamental business, the underlying fundamentals of the business are sound. And that's what we saw, right? So our ability to say, okay, you've just had $1 million dirhams converted, which is roughly $250,000. You've just had that converted into a term finance that you've got to repay in a year. That is going to stretch the business. We will take that, allow you to repay the bank, and we'll put that on a 24-month loan, which you can manage. You can support that level of debt, and you can continue trading or continue operating because your business is doing very well. So, but again, that's a case-by-case basis. You have to be able to look at that. But having a flatter structure allowed us to make decisions like that. And we did a similar thing in COVID.
Yeah,
I mean, obviously, COVID, nobody knew what was going to happen. When you're operating in the financial space and your lenders or individuals and institutions, they've got to have confidence that they want to continue to lend to SMEs. SMEs were struggling initially, nobody, lockdown. So we worked with SMEs and we worked with investors to try to help support the SMEs through what essentially was a liquidity crunch.
Yeah.
Right. There is no point kicking an SME when it's, if it's not doing any revenue because everybody's in lockdown. Asking them to make a repayment is
pointless.
It's pointless.
Yeah.
You're just exacerbating the problem.
Yeah.
So creating a 3 or 4 month holiday, letting the businesses just ride out the lockdown, allowed so many of those SMEs to come back, start operating again. Some SMEs actually thrived in lockdown, right? Because the nature of their businesses. But for a lot of SMEs, they just needed that breathing space. And then as the economy came back on track, they were able to just get straight back on track, make the repayments, ensuring that the investors got not just their capital, but also got their profit interest.
And I'm sure
on top of
different
that.
industries had different kind of impact, right? The F&B industry, for example, or the travel industry had a really hard time in COVID.
Yes.
And I'm sure you've seen that playing out in the loss rates by sector.
Yeah, you absolutely. Some businesses suffered. Some of the e-commerce players saw a huge spike.
Yeah.
People selling e-commerce.
Yeah.
In fact, they were coming to us.
Supermarkets.
Yeah, they were coming to us to say, look, we want to get more stock. Right, this thing's flying off our shelves.
Yeah.
So our ability to go and buy more of this is why we're looking to raise. Why we're looking for lending. So yeah, you saw it across different industries. Some, as I said, saw a massive spike in business. Others saw a complete and utter drop in revenue to virtually zero. But you knew their business was sound once an economy came back online. And the good thing about the UAE is the UAE came back on track 3 or 4 months later. And I would say probably 6 or 7 months later was back up to full speed. And businesses were able to essentially kind of continue where they left off.
Craig, when you assess credit for SMEs, do you use alternate sources of data apart from financials to complement your risk scores?
Yeah, we will look at various alternative sources. Some of it will be API'd from other institutions where we feel that is useful information. But also we will look at, as I said, the individuals behind the business. We'll look around that whole willingness space, which I think is incredibly important, particularly when you're lending into an environment which is 90% expat, right? And that was always one of the challenges of SME lending in the UAE, was because there was a lot of the SMEs were owned and run by expats. Then you also had a flight risk element to credit, which doesn't exist in a lot of other markets.
Yeah, correct.
If businesses get into trouble, the people behind the business aren't necessarily going to leave the country. Whereas that was always a challenge in the UAE. So that willingness aspect becomes incredibly important. Yeah. And alternative data sources around information that help build a picture were important to us. And we continue to take more and more feeds as they come online with different third-party sources. And that's what we're seeing more and more in region now. The ability to start APIing to more data is a huge fillip for region, and I think will only continue.
Yep.
And then when you start to bring in things like open banking, or you start to access past financial historical data that's sitting in bank accounts and activity that's happened there as well, there's a great treasure trove of data to be pulled in and assimilated into credit models.
Yes. Craig, let's move now to loan turnaround times. Beehive funds its borrowers 24 to 48 hours after completion of subscription forms and requirements that you have from your borrowers. A typical bank in the region takes 3 to 4 weeks, I would say, to arrive at the same decision. I've been to China, seen Ant Financial and others, they disburse loans in minutes. Where should SMEs be in the spectrum? I mean, are we looking at going into minutes very soon in this region?
Yeah, it's an interesting question. And I have this debate with people all the time. I think, again, you've got to understand the customer base. So when in the industry people are talking about, credit decision is made in seconds, money dispersed in minutes. That's very much has come from the kind of retail space, right? The consumer space. Because the data is already residing there, and typically you are making a decision that will cap out at a relatively small amount of money. So a great example of that has happened globally, happens in region, buy now, pay later. Right? If somebody goes to the checkout, but it's going to be capped. So if that's capped in Europe at €1,000, it's essentially a credit card type decision. Right? In the same way that years ago you'd get mail to say you'd been pre-approved for £1,500 for a credit card. Right? It's a normal distribution curve. You're looking at it, you're making some general assumptions, and you're pricing that in to the proposition. For an SME, a lot of SMEs, when they're looking at, okay, do we need to take some debt on? It's not a decision that they decide, they don't decide that in 1 minute. It's typically, there is a requirement coming up.
Correct.
Right? There's either some stock to be bought, there's some people to be hired, there's some project to be started. So they have forewarning of that. So what you're really trying to do is find a sweet spot that means that they can collect the information, because you're going to collect a lot more information to assess an SME than you are to assess an individual. They're able to pull that information together. They're able to apply, maybe answer some supplementary questions or provide some supplementary information. The most important thing for an SME then is to understand, am I going to be accepted or am I going to be rejected? And the frustration for a lot of SME owners was typically in the past, they'd collect a lot of information, and it was a bank typically, and they'd be going to, they would give that information to their RM, it would then disappear into a black hole. Silence. They wouldn't hear anything for 6 weeks. Then the RM may come back and say, just to let you know, the answer's going to be no. Right? Having not heard anything for 6 weeks. Correct. And that's because it's moved its way through a credit committee and it's been rejected. So I always say the most important thing for an SME is time to finance. And time to finance encapsulates a number of aspects. But one of those aspects as well, and it sounds counterintuitive, is if the answer is going to be no, let them know as quickly as possible so they can go and look at alternatives. Because, and it's one of the things that we try to do is we'll collect almost like that basic information, and very quickly that will give us a very strong steer as to whether we feel that we will be able to help that business or not. And if we can't help them, we should be telling them very quickly, listen, it's too early in your journey, or you're not, some of your metrics aren't where they need to be at the moment, but hey, look, you seem to be on the right journey. Come back to us in 6 months, 12 months, 18 months, whatever it might be.
So say no quickly.
But say no quickly so that the person behind that business can say, right, okay, I need to look at alternatives, or I might need to raise some equity, or I might need to go to friends and family. And so I think that's particularly important. But when we're looking at it, if we then see that it looks as if everything is in a good place, again, we'll be going back to them saying, look, initially, this looks very strong application. We're going to need a bit more information. Hopefully, all the rest of the checks will check out. But based on the kind of headlines, we think we'll be able to help you. And a lot of that is communicate. If you're giving people bad news, okay, they're upset for a short space of time, but they prefer to have that because by default, if you've set up a business and you're an SME owner or a startup owner, you're a problem solver. By instinct. So what you want to know is you want to know the information. Is Beehive going to be able to help me? Yes or no? is the bank going to be able to help me? Yes or no? If it's no, fine, I can accept that. I'm a grown up. I'll go off and I'll find another solution. If it's yes, okay, give me an idea of roughly when that's going to be. So then, going back to your initial question, how long does that need to be? If I know that money's coming, whether that money comes in 3 days, 4 days, 5 days, that's not making the difference for me. Yeah. The important thing is I know it's coming, and therefore, if that money's going to be in my bank in a week's time, great. Yeah.
So minutes doesn't make a difference to SMEs, what you're saying?
For SMEs, if you were looking at things like term finance, as in amortized lending, 2-year loans, 3-year loans, I don't think it needs to be in minutes. Now, if you're talking about some e-commerce where the platform has got all your trading data, you sell completely on the e-commerce platform, and your business is buying stock and selling stock, then a lending institution might be able to give you a decision in minutes. I would argue, maybe 1 or 2% of the cases that makes a difference. Yeah. But if I'm buying stock from Italy to sell in the UAE, you give me a decision in 2 minutes that I can access another $50,000. That's not going to make the difference. I've still got to buy some stock from Italy. Right? That's going to take some time. So I think it really comes back to elapsed time and what is required by the business. Business does not need the access that an individual needs instantaneous, in my view. Yeah.
And for the credits we approve, Craig, what % get what they wanted originally?
Yeah. So again, whenever we're looking at a credit assessment, if a business is looking for X, we think they're a strong business, but we don't think that they can support X at the moment. They might get 0.8 of X or 0.6 of X. But again, that's part of the communication. You go back to them, say, listen, in our view, you need 0.8X. We're happy to extend that. That fits the model well. And a lot of times businesses say, yeah, fine. Right? Because that doesn't preclude them coming back to us in 6 months' time and taking another line. So again, I think a lot of this comes back to communication, right? And it's customer experience. So, and that's why SMEs are different than retail, in my view. And they're very different than corporate.
Craig, Ian Enterprise took a majority stake in Beehive in 2023. And you've been running under the Ian Enterprise umbrella since then. How has life changed for Beehive in general and for you personally as a CEO post-acquisition? Do you feel more empowered, more restrained, or what? Do you get energy and more capital for the next wave of growth? And a separate question to that is, what are the synergies that you're looking to exploit with Ian?
So, when Ian Enterprise came on board in 2023, they became a majority shareholder. That really kicked off Beehive 2.0 for us. So there was a capital injection alongside them taking a majority stake. And really what that has allowed Beehive to do is look at 24, 25, 26 as Beehive 2.0 with some fairly ambitious targets that I'm looking to do 10x the business, right? So looking to try to 10x the business. So 2024 for us was very much a foundational year and putting in place some key kind of building blocks. And we achieved those in 2024. And that sets us on a huge acceleration through 2025, which means, so back to your point, it massively energizes us as an organization because we can see how we can 10x the business. We can see how we can combine what we do with access through the likes of Ian. Ian are the largest, obviously the largest telco operator in the UAE. They have a huge SME install base. Something like 80% of the install base. So the opportunity for us to work with Ian, SMB team, and to access is huge, right? I mean, it's larger than any bank, any financial institution in region. So there's an awful lot of opportunity, but you can't just rush into that. You have to put the foundational building blocks in place. So you need to make sure that we are accessing more liquidity because we can see a lot more origination opportunities, more SMEs that we can help. And individually, I think it just kicks off a new chapter, right? So, an entrepreneurial journey is something that from the outside, a lot of people say, I want to be an entrepreneur, I want to do it. It's hard work, right? I think anybody that tells you otherwise is probably being slightly disingenuous. It can feel quite lonely. At times. You never really turn off. Right. So even holidays or weekends, you may not be tapping away on a laptop, but the mind is always thinking. Right. You're always problem solving, troubleshooting. Either anticipation of something that you're trying to achieve or managing something that has gone sideways. So you're always on. So when you then reach certain milestones, one of the things you have to be able to do is at least, celebrate that, celebrate achieving a milestone, and then kind of use that to re-energize to say, right, okay, what is the next mission? And for us, Beehive 2.0 is something that we can build around a vision. I like to think it's something that has pulled together the whole team. Beehive with just over 100 people across our offices in region. You need to be able to galvanize people around a common theme and a common message, but also a common vision. And something that scares people a little bit, but excites them. And that was what was really important, that even, somebody at such an organization as large as EAND coming on board, all it does is give us an opportunity to go after something exciting in the future. And that, I think, has been critical for us. Right?
And talking of synergies with EAND, Craig, I'm sure you use telephony data for your customers, right? That gives you quite a bit of insight into at least some parts of the business, right? Are you leveraging that data?
We are starting to look at that data. Again, how that data can be shared, a lot of it is reliant on the end user being able to give approvals.
Correct.
Right. So a lot of data. What you have to do is you have to come up with solutions and processes that allow you to access that. Right. And that goes across lots of different environments with lots of different regulations. You need, ultimately, typically relies on the end user, i.e. the SME in this case, to be able to give approvals. You can use my data, you can access that data, you can view that data. So what you have to do is, of course you want to incorporate that data, but how do you incorporate that by reducing the friction? It's all about friction. Right? If you can reduce the friction and access the data, great. If the friction is too much to access that data, and the incremental value of that data is minimal, then why would you introduce a frustrating, frictional process?
It's not worth it.
So it's a balancing act.
Let's now talk about partnerships, Craig. You, as Beehive, have set up successful partnerships with both commercial and development banks in the region. You have Emirates Development Bank in the UAE, you have ADCB in the UAE, Gulf International Bank in KSA, Social Development Bank in KSA, and others. How have you seen these partnerships developing, and what are the models you're using for the partnership?
So we use, I think we try to look at what is the most appropriate model in market, or what is the most appropriate model to a customer base. So we have different models that we work with different banks on. So in some scenarios, like Emirates Development Bank, we work alongside them to help almost at a granular level. Right. So Emirates Development Bank is supporting companies across the UAE of all different sizes. And a lot of their focus will typically be on slightly bigger ticket. Yeah, they want to focus on 5, 10 million plus dirham lends.
Yeah.
So what we're able to do is help EDB target those kind of lower level lends, those 1 million dirhams, 1.5 million dirhams, and use our models, our skill sets, our kind of granular approach to help support businesses that fall under some of the strategic pillars that EDB wants to support.
Yep.
So it's almost like a perfect matching between ourselves looking at almost the micro/S, and the EDB looking at the higher S and the M of the SME.
Yeah.
So I think that's one area. Again, we do similar type of things with Social Development Bank in KSA, because again, it's about having that granularity, and we're starting to see some real clear, delineation between where banks, commercial banks as well, want to operate, and typically the ticket sizes that they want to lend, and the business size that they're willing to lend to. And we fit quite well below that. So if you look at various different banks, they will have cut-off. You will know this from your days. Typically, they may just have a top-down approach that says, if the revenue of business is below X, we just won't lend.
Correct.
Right? And that's got nothing to do with the quality of an individual business. It's a decision almost based at board level. Well, that then creates an opportunity for Beehive to work with those banks and say, well, listen, if your cutoff is, 25 million dirhams revenue, right? Well, that's a sweet spot for us. We're happy to lend to businesses that are turning over between 5 million and 25 million dirhams. The banks, and there's no competition there, because the banks have a policy not to lend there, right? So I think when you can see that type of clear cooperation opportunity, then it's just getting everybody on board from both sides to say, look, this is a win-win if we can do this. And that's one of the things that we focused heavily on over the last kind of 12 months. And, we're now starting to see the fruit of that in some of the partnerships that we're doing with the banks. On the other side, for some of the banks, we are helping them, in KSA, put their balance sheet to work, right? So it's not Beehive or Beehive investors that are doing the lend, but actually the banks. It's the bank balance sheet. It's the bank doing the lend. But the reason we've been able to have these partnerships is because of the performance of our NPLs and our book over the last decade. And that's what has given the confidence to our partners to trust the Beehive credit models, the Beehive operational processes, and our KYC AML approach to make sure that we can meet the regulatory standards that a bank has to meet as part of its regulatory obligations.
So your model in KSA is different from your model in UAE?
Yes. Yeah. So in KSA, we're helping the banks put their balance sheet to work in the market. In the UAE, we're doing a combination. In Oman, we're doing a combination.
Now, Beehive has helped over 1,200, 1,500 businesses in their growth across different sectors, different profiles. Do you have any favorite success stories that you're able to share, Craig, about businesses that have transformed because of Beehive's intervention?
Yeah, so I look at, I think one of the businesses that comes to mind is in the fitness space, Squat Wolf. So Squat Wolf, they have received multiple funding rounds, lending rounds from Beehive. And one of the things that we've seen is an exponential growth in the success of that business. And I think every time they've come back to Beehive, it has been because it's been helping fund the next round of growth. So they've expanded, they were essentially born in the UAE. They've expanded across region. When China was coming out of COVID and the lockdown, they were able to take borrowing over Beehive to help diversify some of their manufacturing facilities. So again, strengthening that business at the back end on the manufacturing side. But then they've also taken borrowing from us to help open They opened, I think, in 2024, their first store in Dubai, right? So then they had a physical presence as well as just an online presence. So as the business has evolved, different lending products and structures has helped them address whatever the next hurdle they've had. So sometimes that might be, so if you take opening a store, that's a bit more like project finance, right? So they've had the ability to take over Beehive a project finance over 12 months where they're not repaying capital every month. They're just making the interest or the profit rate, the profit rate repayments. And then it's a capital balloon at the end. That works for a certain type of projects. Other times you're looking at short-term financing because you want to be able to pay suppliers. 90 days, 120 days. Other times you're looking to take term finance, an amortized loan over 24 months, because that's the right. So I think what we've been able to do with companies like Scott Wolf is we don't have one size fits all. We're able to tailor different product offerings at different times to help the company grow.
And you believe you're more flexible than banks in this respect?
Yes. Yeah. I think I'd like to think that I guess, the empirical evidence is there as to how we, because for us, we're looking at the business. How you structure a credit product is a function essentially of repayment schedules, split between capital and profit. But because from a technology point of view, we've developed all our platforms and all our technology in-house, we have a great degree of flexibility. We're born on the cloud. We're able to implement functionality and features very quickly. So we can bring new models to market that can reflect the requirements of businesses.
Let's move from borrowers to investors now, Craig. For retail investors who wish to make a start as an investor, in the P2P lending space, let's say Beehive, what advice would you have in how to make a beginning? How should I assess as an investor which projects to participate in and to what extent? And how do I make a a trade-off between benefits and risks?
So I think the first thing to say, and I think it's incredibly important, is anything such as peer-to-peer lending, it's an alternative investment, right? So it's an alternative investment space. So any kind of portfolio allocation to alternatives, it's typically going to be in the low single digits of your portfolio. And we sit very much in that fixed income space. So as part of a diversified portfolio, the thing that we encourage people to do is if they come onto a platform like Beehive, is our ability to let you put relatively small investments into each lend and therefore diversify your investment across many different businesses is critical. You are going to get some bad debts. That is business. That is why the returns are what they are, because you have to allocate. There has to be a risk premium to allow for that. So, if somebody was to come onto the platform, start with 50,000 dirhams to put onto the platform, but that 50,000 dirhams might be spread across 100 businesses. So if they're able to diversify across, one or two or three of those businesses go bad at some point through that loan repayment schedule. But if on the flip side of that, you're making 12% or 13%, then by the time you net everything off, you're still returning about 10% on your investment, right? Which isn't essentially calibrated to the stock markets. So if you look at the stock markets, clearly, they can be up, as they have been for the last few years, but also they can be down, right? They can be down considerably with capital. So we sit within fixed income, but we sit within alternative investments. And again, I think it's important that people treat it just like an asset class. So again, they put a relatively small percentage of the kind of net wealth into it, then use our automated tools that just means they diversify across many different businesses. And just treat it as an asset class. Yeah. So, whether you're holding some gold or you're holding some crypto or you're holding some, real estate, whatever, you're going to have a bunch of alternative investments. That's where it sits.
And your tool helps me to diversify automatically?
Yes. Yeah. So you will just go in, you'll set up your settings, and we will continue to move to more and more and more auto bids and diversification because it's what we see investors prefer. And quite frankly, it just allows investors to treat it like an asset class and make sure that they're diversified across many different businesses.
And Craig, with areas such as climate change and sustainability becoming more important, do you see investor priorities shifting? Do you provide an added weightage, for example, in your credit and lending decisions to these areas?
In the whole space of ESG, we do have some considerations within our model on ESG. And that, again, is in reflection of investor kind of desires, requirements, interest. And that may come from individuals or it may come from institutions. Right? Some institutions may have a particular interest in that area and want to only be investing in that space. So we do reflect it, but also we have to be mindful that ultimately our focus is on trying to make sure that we are lending to creditworthy businesses. The financials stack up, the risk return is commensurate, and we will continue to incorporate ESG into the credit models, but never at the kind of expense of solid credit assessment, ability and willingness to repay.
Understood. Craig, turning to you as a person now, you've set up and successfully exited, one partially, 2 startups in different fields. One was software, your earlier one, now finance. What is your advice to budding entrepreneurs in the region to help them navigate their journeys? Have you used a role model or a mentor? How does one become a successful entrepreneur?
Yeah, good question. I think there's probably a number of there's a number of aspects to that. So first of all, people need. If you want to set up a business and you want to be, in quotation marks, an entrepreneur. You need to set out with the end in mind, right? You need to be kind of clear as to why am I doing this. You've got to have a passion about it. Right? And now, when I say a passion, I don't mean a passion in the same way that people might do for a hobby, but you've got to believe that you are solving a problem. Right? Because too many times people come up with solutions and then the solution's looking for a problem. You've got to be trying to solve a problem that is in the market that people are willing to pay for.
Correct.
And that's the key, right? People have got to be willing to pay for whatever you're going to offer and see value in that. Otherwise, it's a vanity project. So that's the first thing. And a lot of times, and to understand that is actually to be quite open when you speak to potential mentors, potential partners, potential staff members who might come and join you on that journey, is to try to be quite open in those discussions. This is what I'm trying to solve. I think there's an issue here. I think we can solve it, X, Y, Z, blah, blah, blah. Because too many times people become very closed. I've got an idea and, I don't want anybody to know about this and I think it's going to change the world. And the danger there is you're in an echo chamber, right? You're just constantly reaffirming what you think is a problem. And the danger there is, one, you may never actually launch anything to market because you're constantly trying to improve it. You're just, oh, no, I've got to wait till it's better. Nothing beats actually starting, getting an MVP of some sort, getting to market and testing it against the real world. Because if you're going to fail with an idea, fail quickly, right? That's incredibly important. So for a lot of people, first of all, do you want to be somebody that is going to go on that kind of journey? I think you have to look at any kind of business setup and say, I need to make sure I put a strong team together. Right? It's not a solo race.
Yeah.
It's a relay. Anything like this is a relay. So it's important that you find 2 or 3 key individuals that can be part of your kind of founding team
Yeah.
and can help take some of the weight, right? And the important thing is to get people who know their areas.
Yeah.
Right.
Yeah.
So, that they can almost stay in their lane, but they are a solid performer in that area because you are going to rely on them hugely. So again, put together a decent team, understand what you're trying to achieve. And when I said, Craig, start with the end in mind, is what is the end game for that business? Do you want to sell that business? Do you want to list that business? Is this going to be a lifestyle business for the next 25 years? Do you want to hand it down to your children? What type of business are you trying to create? Because if you're trying to create a business that you know will be sold to a larger organization at some point in the future, again, you begin with the end in mind.
Yeah.
Okay, I need to build a value proposition that will be attractive to a S&P 500 business, right? Or a regional champion will want to buy us because we will complement them, we will accelerate them. They can extract a lot more value out of what we've created post-acquisition. Yeah.
Correct.
If you want to IPO, you've got to create a story, you've got to create that path to profitability and then super profitability.
Totally.
Yeah. Or if you want to hand this down to your children, it's a completely different business. And you will build the business differently. You will build it probably slower. You will take less risk, right? You grow. It won't be growth.
Yeah.
So depending on where you want to end up is really the determinant about how you map that journey and the timelines on that. Yeah. So I think that's incredibly important to establish. And then, as we touched on earlier, I think find 1 or 2 good mentors, right? People that can help you navigate, but people that typically have already got some of the scars on their back, right? Because they can save you a lot of pain to make sure that you don't go down, cul-de-sacs, as we say.
Yeah.
Because too many times people are clearly excited. They've got a product, they've got a proposition. They look at the market. On paper, everything looks hunky-dory. Oh, it's a no-brainer. It's a no-brainer. No, but that's not what kind of is the undoing of many businesses.
Yeah.
Business ideas, it all comes down to execution.
Yeah.
Right? And execution is hard yards. It's putting it in, day out, and trying to minimize the mistakes that you make, because those mistakes can be very costly, particularly if you're a business that is using external funding rounds in order to build. If you can find the right mentors or the right advisors that can help you avoid some of those traps, that can pay huge dividends over time, right? You're there to take risks, but you want to mitigate those risks as much as possible. And that's what having the right type of advisors who maybe walk that journey themselves, right?
Yeah.
They can really help. Yeah. But you've got to be open to listen to some of that. Yeah. But ultimately, you're still responsible for driving that business.
Yeah.
You have to stand and fall on your own decisions, but you'd be a fool not to at least take in, opinions and advice from people that may have already trodden that journey.
Well said, Craig. And that brings me to my last question of the day, which is on leadership. I always ask a question on leadership at the end. You named your current business Beehive. As you said, you see your team much like a beehive with every team member playing an important and active part. You also said that you see yourself as an orchestra conductor with each member playing the instrument perfectly. Craig, can you elaborate on some of your leadership principles?
So I would say one of the things, and I guess over 10 years or 14, 15 years, which has been my entrepreneurial journey, teamwork is incredibly important. And one of the challenges as an entrepreneur is, day one, there's a handful of people, right? If that.
Yeah.
and you are involved in every decision. You are over every detail.
Yeah.
As the business grows, by default, you cannot be across everything. Now, actually, some people try to, and I think that creates more problems than benefits it brings.
Yeah.
Because it does two things. One, it spreads the kind of leadership too thin. And secondly, it doesn't empower the next wave or the next kind of level of team, and sometimes next generation.
Yeah.
So one of the things that I've tried to do and consistently do, and that goes back, I guess, to the conductor reference, is I expect everybody in the organization to be better at their job than I could be.
Mm-hmm.
Yeah? Mm-hmm. Because it's not my job to do their roles.
Correct.
It's my job to map out a destination of where we're trying to go to. Mm-hmm. It's my job to be able to hopefully not just galvanize people, but inspire that we can achieve this. Yes, we might need to dig deep. Yes, it may be a little scary, but we will give you the tools to do the job. Mm-hmm. We will give you the incentives to achieve the targets that we're trying to achieve as an organization. Your people are going to make mistakes.
Yeah.
And you've got to trade off getting frustrated about the odd mistake being made versus the multiplication effect of having good people in roles and what as a business you can achieve. So I'm very clear. I hope I'm very clear with the team, which is I don't mind us making mistakes. I would get frustrated if we don't learn from those mistakes. And we don't then use those learnings to make a better product or a better offering or better decisions going forward. But I also think it's your job to mentor people and be quite available to the team as well, right? So again, the senior leadership team at Beehive, people can knock, they can come and have a coffee. Right? They can come and just chat. They can get around a whiteboard. They can come with an idea. One of the things that we've been able to do is empower even our more junior staff to go and run with an idea, right? Particularly if, at the end of the day, they're working up an idea conceptually. Yeah. Let them run with that because that degree of empowerment excites and drives them. And, I'm a big believer in the key to commitment is involvement. And if you can get people involved in the decision-making process, they become far more committed to the outcome of that.
Absolutely.
So it's again, very easy for people to come, we look at something, it doesn't work, fine. We've spent, a week on it, fine. If it's going to fail, it's going to fail. But the learning curve is huge. And one of the things that I said at one of our strategy days to some of the younger team, like, look, everybody can go in various different directions as they come out of the likes of university, and do you go and work at a large corporate? Do you go into the startup world, whatever it might be? Do you go on to get a master's? Yeah, I said, if you work at somewhere like a Beehive or an environment that is fast moving, where you can get access to the leadership team, you can kind of run with ideas, you can explore propositions. It's almost like you're on a paid MBA. Yeah. Right? The learning curve is huge. And you're testing things in the real world. And look, a lot of things may not work, but you are getting paid to go on a journey. And I fully expect, as some have already done, the alumni of Beehive will invariably set up a raft of businesses. I can already see some individuals that invariably the next 2, 3, 4, 5 years, they'll be entrepreneurs themselves. But they've been able to see firsthand and up close what it takes to grow an organization, the growing pains, the setbacks. We've had plenty of setbacks, but you typically learn more in the setbacks than you do in the successes, and the successes are only a culmination of a lot of setbacks. So, I continue to try to be more and more hands-off from a day-to-day because, quite frankly, Beehive shouldn't need me to run day-to-day. My role is to say, right, where are we going next? Right? What's the next big mountain to climb?
Yeah.
And that's what excites me as well. And I think that filters down across the organization as to what is the next challenge and what's the next excitement going to be.
Very well said, Craig. Craig Moore, founder and CEO of Beehive. Thank you so much for all your insights today. I couldn't have imagined a better closure, honestly, to season 1 of Money Majlis than to have you as a guest today. Your passion, your honesty, and your ambition is clear to me and to all our listeners. And on their behalf, I want to wish you the very best for the second decade of Beehive.
Thank you very much.
This podcast is proudly brought to you by MasterCard.
Money Majlis is sponsored by WEO Bank. Fuel your ambitions with banking designed to power your success. Discover more at weo.io.
Money Majlis is brought to you by Network International, the leading digital payments technology company in the Middle East and Africa.
Money Majlis is proudly supported by Aqua Now, the premier crypto as a service provider, now building in partnership with the top financial institutions in the Middle East. Discover more at aquanow.com.
So that's it for this episode and for this season of Money Majlis. Thank you for listening to all the 28 episodes of season 1, and thank you for voting for Money Majlis as the best new podcast for 2024 in the Pod Club Listeners' Choice Awards. I'm truly grateful for your love and for your support. I hope you'll give me the same support and same love as I embark on season 2 of Money Majlis starting next Friday. I promise you a more exciting season with even more insightful content from movers, shakers, and leaders from the worlds of banking, finance, technology, and marketing. So please like, follow, or subscribe to Money Majlis on your favorite podcast channel so that you're automatically alerted of every new episode being released. Till next time, goodbye, stay well, and do good.